All right, in this lesson, we're going to look at the taxes that are associated with an employer. In the last lesson, we looked at taxes associated on the employee, but one of the things that you might not know is that when an employer has employees, they are also subject to certain taxes associated with the employment of different people. And so as such, we're going to be looking at that side of the house, which is what the employer is going to have to pay in employment taxes because they've hired employees. So let's dive in here and talk a little bit about the accrued payroll for employers. So when companies pay their employees, the wages and salaries expense they incur doesn't just stop at gross pay. They do have some taxes associated with the employment of people. So employers have additional obligations or additional costs they must take into account when it comes to payroll expenses based on the area in which they employ people. Now, one specific thing to think about while we're talking about employers' taxes is that the taxes that we are going to talk a little bit about are the most general ones that all employers pay some type of an amount to the federal or state government. But just know that every state has their own rules. They have their own jurisdictions. Every city and county has their own rules. And so depending on where you are employing employees, you may have more taxes or more expenses than the ones that we're going to be talking about here. But these are the most broadest ones possible. So the first one here is FICA. We talked about FICA in the last lesson. Employers are responsible for their portion of FICA. The newest tax that we're going to be talking about in this lesson is FUTA as well as SUTA. FUTA is the Federal Unemployment Insurance Tax Act. And then the state or the SUTA would be the state version of the federal version. We'll talk more about that in a few minutes here. And again, additionally, there may be other possible employment related taxes that we're not going to cover, but it is going to be required to be paid by the employer depending on what state they are in or what county they're in or even what city they are in. So these are employer obligations. So the employee doesn't pay a dime into these taxes. It is all the employer when it comes to funding this FICA, FUTA, and SUTA. Okay, so let's talk a little bit about the FICA. So employers are required by law to match the amount of FICA paid by the employee. So we've said that for the employee, they have to pay Social Security in the amount of 6.2%. And then Medicare in the amount of 1.45%. So just like the employee is going to pay 6.2% on their end, the employer is going to pay 6.2% on their end for a total of 12.4%. On the Medicare side, the employee is going to pay 1.45% and the employer is also going to pay 1.45% for a total of 2.9%. So understanding that an employer's responsibility is to pay the exact same amount as the employee does when it comes to their portion of FICA. This also means that if you're self-employed, you are both the employee and the employer, and as such, you'll have to pay both amounts. So that's why you often hear self-employed individuals say that they have to pay 15.3%. That's because they are considered the employee and the employer when it comes to these taxes. And that doesn't even scratch the surface when it comes to income taxes. So this is going to account for 15.3%. And then they have their income taxes that they're also going to have to factor in to the tax problem. But we'll skip that here. We'll just worry about our employers, which is the Social Security and Medicare, their portion of those taxes. The other most broad taxes is the FUTA and SUTA. Unemployment insurance is paid by the employer, not the employee. This is used to pay employees who have been involuntarily unemployed. So the key word here is involuntarily. So if you quit, if you leave, if you get fired, you cannot obtain unemployment insurance. Okay, so the basis of unemployment insurance is that the employer lets you go. Usually they're trying to downsize or something to that effect. It is not because you did something wrong. So if you were fired because you did something wrong, you may not receive any FUTA or SUTA or unemployment insurance. And then obviously if you leave, that's on your terms, you don't get FUTA or SUTA, okay? Now, some states take on the task of unemployment and managing that, and other states don't. That's why there is a FUTA and SUTA. Basically, how it works is that if a state does have their own unemployment insurance program, there will be like a maximum that all companies will pay. So maybe that's 6.2%. So whether you are in a state that has it or not, the federal government says the unemployment insurance rate is 6.2%. And then what the federal government does is they subtract what you pay the state. So for instance, if your state has a 5% state unemployment insurance, then you will pay 5% to your state, and then to the federal government, you would pay the rest, 1.2%. If you're in a state that doesn't have an unemployment insurance plan, then you would pay 0 to the state, but then 6.2% to the federal government, and vice versa, depending on what you would pay to the state. Some states just want to have their own program and administer it themselves. Others don't want to have that headache, and so they leave it up to the federal government. So depending on how it works, there is this maximum that all employers pay, and then from there it kind of gets divvied up based on if your state has a plan or if they don't have a plan. So that's more than you need to know with FUTA and SUTA. All you need to know is that is a tax that an employer is going to be responsible for, but you are not as an employee. All right, so what does this look like from a journal entry standpoint? So if you remember in the last lesson, we gave you a picture of a paycheck. This section right here that's on your screen, we didn't cover. We just kind of just said skip it. But now we're going to have to journalize these. So this is a breakdown of all of the taxes that the employer is going to pay on behalf of the employee, but it's paid for and it's an expense of the employer. So the employee didn't pay any of these taxes, but the employer did. So these are all expenses to the employer, and as such, they get to deduct it as an expense. So these right here represent the expense. And so what we're going to do is we're going to increase the expense by the total amount, and we're going to put that into a debit. So we're going to debit payroll, tax, expense. And if you were to add all of that up, you should get $173.90. Okay, so that's all the taxes that the employer is paying. And then we're going to break it up based on who's going to get the money. So there are many ways to do this. There isn't a perfect way of doing it. Some will do it based on category. So they'll have a Social Security liability, Medicare liability, FUTA liability, California SUI liability, California ETT liability, and then some companies will block it into just one account, payroll tax liability, and then that's the account that it goes into. We're going to break it out just a little bit, but not to each line. So we're going to combine our FICA, we're going to leave FUTA alone, and then we're going to combine all of our California liabilities. So as such, they are liabilities. Increases in liabilities are credits. So we're going to go FICA payable, because we're going to owe it to the federal government in the amount of $113.22. That's the addition of Social Security and Medicare. We also have unemployment tax, so unemployment tax payable, and that amounts to $8.88. And then we have our California withholdings. So we're just going to put California withholdings payable. So California withholdings. Payable. And if we add up all of the California stuff, we get 5180. So that's what our journal entry is going to look like. When we pay an employee, this is the journal entry that we're going to make for the employer's portion of their taxes. So we've got the employee's journal entry and the employer's. So that's what this looks like from an employer's standpoint. So that is our talk here, or our lesson on accrued payroll from the employer's deduction side of the house. Again, if you become an employer or you become self-employed, you're going to have to do this and pay this on your own side because you are the employer as well as the employee. If you're working for an employer and trying to do their books, they're going to have their own taxes that are going to have to be put onto their financial statements, and this is representative of those taxes. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and I'll take you to that video. So until then, we'll see you in the next lesson.